Hello and thank you for joining us in this episode of PhillipCapital's Market Watch. My name is John Chu and I'm a dealer from the Contract for Difference dealing team. With geopolitical tensions rising globally, markets have become increasingly uncertain. In times like this, one asset consistently comes back into focus: gold. Today, we'll take a closer look at why gold matters during periods of conflict and geopolitical tensions, and how investors typically think about gold in uncertain environments. As geopolitical tensions rise, gold tends to regain prominence among investors. Across history, gold has played an important role during periods of uncertainty. While every geopolitical event affects market differently, investors continue to view gold as a defensive asset that can help stabilize portfolios when market volatility increases. So why do investors tend to turn to gold during periods of conflict? The first key reason is gold's perceived stability amidst uncertainty. During times of geopolitical tensions or political instability, it becomes more difficult to assess the outlook for economic growth, currency movements, and overall financial market performance. This uncertainty can lead to increased volatility across asset classes. In such environments, investors often rebalance their portfolios by allocating more towards assets that are perceived to be more stable. Gold has historically played this role as it is not tied to any single economy or corporate performance. The second key reason is diversification. In a typical portfolio, assets such as equities and bonds tend to be influenced by economic growth, interest rates, and corporate performance. During periods of market stress, these assets may move in the same direction, increasing overall portfolio volatility. Gold, however, behaves differently. Unlike equities, gold is not linked to company earnings. Unlike bonds, it does not rely on interest payments. As a result, gold often exhibits a low or even negative correlation with traditional financial assets. During volatile periods, this diversification effect can help reduce overall portfolio risk and improve stability. Another reason investors pay attention to gold during geopolitical tensions is its role as a store of value. Unlike currencies, which depend on the economic strength and policy decisions of individual countries, gold is recognized globally as a defensive asset. When investors become more cautious about currency movements or broader financial stability, they may increase their allocation to gold as a way to preserve value. As uncertainty increases, gold often serves as an alternative asset that helps provide additional resilience within a diversified portfolio. Another important but sometimes overlooked driver of gold demand comes from central banks. Many central banks hold gold as part of their foreign reserves. During periods of geopolitical uncertainty, some countries increase gold holdings to diversify away from reliance on major reserve currencies. This ongoing accumulation supports long-term demand and reinforces gold's role as a strategic reserve asset at both institutional and national levels. Interestingly, gold does not always rise at the onset of a conflict. In the early stages, investors often move into the US dollar, the world's primary reserve currency, while reducing the exposure across other assets to manage liquidity. As a result, short-term volatility in gold prices is common. However, if uncertainty persists, gold typically regains attention as investors gradually increase allocations to defensive assets. This is why gold is often viewed as a strategic allocation rather than a short-term trade. Investors can gain exposure to gold in several ways, depending on their objectives. Some prefer physical gold, such as bars or coins, as a long-term store of values. Others invest in gold ETFs, such as SPDR Gold Shares or iShares Gold Trust, which track gold prices more directly. There are also gold mining companies such as Newmont Corporation and Barrick Gold Mining Corporation, which can benefit from rising gold prices but tend to be more volatile. The approach usually depends on whether investors are looking for portfolio stability or greater sensitivity to movements in gold prices. Although each geopolitical event affects markets differently, gold has remained relevant across multiple periods of uncertainty. As both a store of value and a diversification tool, gold continues to be closely monitored when global risks increase. The key is understanding how gold fits within an overall portfolio strategy, rather than reacting to short-term developments. That's all for this episode of PhillipCapital's Market Watch. If you found this video helpful, don't forget to like, subscribe, and stay tuned for more episodes. Thanks for joining us and see you next time.